Let's say you own a cafe and you've just had a great tourist season. The crowds turned up in droves, you served a record number of customers, and you've now got some spare cash in your business bank account. Your big problem now, if you want to call it a problem, is that you need to decide what to do with the extra money. Should you pay your suppliers early and bring forward the payment of your quarterly sales tax bill? If you did this, you wouldn't have to worry about making those payments next month. Or should you pay down some of the loans you took out a few years ago to buy furniture and equipment for your cafe? If you did this, it would help you pay off the loans early. While both options are enticing, what you may not realize is that what you're really trying to decide is whether you should reduce either your current or non-current liabilities. You see, current liabilities are financial obligations or debts that must be paid for within the next 12 months, while non-current liabilities are financial obligations or debts that won't become due for at least a year. In other words, current liabilities are short-term debts, while non-current liabilities are long-term debts, and that's the key difference between the two. Another difference between current and non-current liabilities is what they're used for. Current liabilities are usually used to help fund the day-to-day activities of a business. For your cafe, this could include accounts payable, which is money owed to your suppliers for buying coffee beans, milk, and other items on credit. Pensions payable, which is money owed to your employees' pension funds that you haven't paid yet. And sales tax payable, which is money owed to the tax office for any taxes due that you haven't paid for yet. Non-current liabilities, on the other hand, are usually used to help grow a business and create profits by using the money to buy or lease non-current assets. For your cafe, this could include furniture and fittings, coffee machines, and the lease on your premises. All of those assets would be used over the long term and could be funded by non-current liabilities, such as loans or lease agreements. So now you know the main differences between current and non-current liabilities, but before you go, there's something you need to know about how they appear on a balance sheet. You see, apart from dividing liabilities into current and non-current sections on a balance sheet, it's important to know that they are also listed in order of shortest term to longest term. So next time you're looking at a balance sheet, you'll be able to tell at a glance which liabilities are due first and which liabilities are due last. That's it for our video on the difference between current and non-current liabilities. Check out our channel and the links below for more videos on assets and liabilities and how to use financial ratios to compare them and assess the health of your business.